One of the hardest things to deal with when you're a beginning trader is when you get stopped out of a trade and you think, oh man, it was probably too tight of a stop. Here comes a video, guys, on how to properly place your stop orders. The multiple uses of those stop orders is where we're going to start things off. There's also a time, and we'll touch on it, when you should not use a line in the sand stop, and proper pricing is going to be key as well, obviously. Let's get right into things here. Tell everyone, Neil, what exactly are we talking about when we say stop order? What is that?
The stop order is simply a conditional order. If condition A is met, then order Y is thrown out here. So I'll give you an example, right? So we'll just look at a level 2 of Cassava Sciences. It could be as simple as if the price is at 75 now, if the price goes lower than 75, so let's say the bid prints 74.99, or you could have it set up that the offer displays 74.99, or you can make it a few cents down. Then you fire a particular type of order. That can be a market sell order, that could be a limit sell order, it can go in the other direction. Once you understand that we're not just talking about covering losses, a conditional order could get you into position. It's a very versatile way to get into position, but it's a line in the sand. A single print, you have a stock doing millions of shares, a single print could trigger you in. A simple price fluctuation to that price can trigger you in or out of a position. Once you understand that, you then need to understand when not to use these before we can actually get into the specifics of how to get these done around.
Yeah, when you don't use a stop, or you shouldn't use a stop, well, let's take a look at some stocks that have spreads, right? Alta was one of those stocks that we were trading today. Why do you not use a stop on Alta? Well, the spread is 30 cents. Do I really want to get ticked in or ticked out of a position because one share was bought at a 30-cent premium compared to the level 1 price? No. So in this case, what you want to do is you want to use the ability to read and how much trading is done at specific prices. In your mind, you're like, you know what, if it gets to this price, I want to get in or I want to get out. See how it trades. And then make sure you execute and you do the stop yourself. That way you have much more control of the flow of activity and you're able to get out because you actually want to get out and not just because there was some random print that within the spread or outside the spread that got you out. And when it comes to trades, spreads matter. And I think in the situation of wide spreads, I think avoiding a hard stop is a good thing.
It's such an important point, and you didn't even have to watch the entire video to get to the pro tip that we promised. There it is, guys. Sometimes when you come to that line in the sand, it's more about how is the stock trading at that specific price versus whether or not it actually broke. It may actually break multiple times and then continue in the same direction. So pro tip, guys, you have to understand and watch the level 2 and understand how the stock is trading when it gets to that price. Now, let's talk about proper pricing. There's a lot of P's in that. But Neil, lead us off here. You know, when it comes to where do we place a stop, what do you look for?
So, like, if you're going to place a stop, you want to make sure that you're at a very, very key level, right? So that's going to be the first thing. Whether you're getting in on a breakout trade or getting out for a stop loss, and I'll give you multiple examples on the same symbol here. Now, always start with a foundation of understanding how the stock trades. As Arun mentioned here, you can have a spread. So if you understand that this is Cassava Sciences, you've seen a 10-cent spread in the time that I've pulled this up. It's opened up to 20 at some points. So you need to know that's the level of slippage. If a level were to break and you're not willing to pay an extra 25 to 30 cents, you're not going to be guaranteed a fill. Might not be the end of the world when getting into position, but it absolutely matters when you're talking about getting out. Now, in this particular situation in Cassava Sciences, I liked two things. The initial one was a long, breaking through, and I only have 2 days worth of data here, breaking through this 84 area. And it had a little bit of a barcode off of this 84 support, and I looked for a simple clean 85 break. Now my stop out, we'll talk about it in a quick second. In that particular case, I just wanted it once it was through the even level because there was an offer there. So in that case, you might just simply put once 85.01 goes, I'm willing to pay up that 25 cents that I've established and then go for it for the long. Maybe you get 01s, maybe you get 85.10. It really doesn't matter in that particular case because I'm willing to give the risk all the way back into that close price area and I'm looking to capture the gap back into this move here where I could take some out at 90s, 96s. So all of a sudden 10, 15 cents doesn't matter as long as I get the position. Now when it comes to the stop out in that particular case, looking at that price area, right in here where it started to break out, this is about 81.50 or so. But I look at the close and it closed at about 80.10 or 80.80. So when I zoom in on this for you guys, I don't believe you should just have sort of an obvious stop. Now, oh yeah, I'm just going to put a line in the sand at 82.50, or I'm just going to put a line in the sand off this level at 81.65. If you're giving a stock more room to the upside, I want $10, $15 winners, I'm willing to say if my support I think is down here, give it an extra 50 or 60 cents, and then place my stop at the even dollar below that price area. In that case, it was 81. So I'm willing to risk an extra 40 or 50 pennies on the stock, sometimes even $1, because I'm looking to extend that trade. And that plays in both directions, right? When I then turn around and go for the short side breakdown trade here, this is clean off a low break from the day before. That is, that's cut and dry. That low gets taken out, 1 penny below. I'm firing an aggressive limit order. I know I want to cross into the book, 20 or 30 cents there. There's no ifs, ands, or buts about it, guys. Like, you want to make sure you catch that fill. But on the flip side of that trade, it's the same thing. If my out is going to be up here at that 81 area, then I'm going to put my stop a little bit higher at that 82, or as Arun mentioned, allow it to trade into that range at 81. Is there a bid above that price? When it breaks this 81, and of course it didn't here, the trade ends up working out to the short side. But if it breaks this 81, are there bidders above that price? Can it hold above that price for any period of time? Is there actual trading activity? Because I have room up here. The stock has accepted trading between 81 and 82, 83. So I can allow it to hang out in that price, knowing that if I want to take $10, $15 out of the trade to the downside, as it ends up giving you here, then I want to be able to risk anywhere from that $2 to $5, and it's reasonable. I just want to make sure that I'm correct. So both having a stop away from that key price, which, hey, look, it cost a bit extra here, but then it made you more here if this one actually had tested higher. So you've got to think about expanding those horizons. That's when you don't want to have that hard stop at the obvious level or that line that everyone can read in the chart, because then you're directionally right and you're making top wick a lot of times, and then it goes against you. And here's what I want to show here, because if you were looking for a trade off of the short side, I waited for the breakdown. If you're looking to make a trade off of this high of the day, or off of this retracement level right here, 84, and you got into it, that would have been a perfect trade to get in at about 83. If you put your hard stop at this line at 84, where everyone saw it put in a lower high, it only goes against you 56 cents, 57 cents before cratering $15. That is an example of being dead right on it holding that lower high area. But if you put the stop at that 84, you're gone. And that's why when I put that 78.50 trade on, there's no way the stop would be sitting there at 81 even. You've got to give it a little bit more room than that when you're trying to take a bigger win. All of those shorts could have had easy stop outs if you just put it at that previous line. That's a stop out. That's a stop out. You got to be able to hold a bit longer.
Yeah, it's a matter of holding. When you get the trades that are going to go, you want to hold as long as possible, because they're finally, you do so much work trying to catch these trades that are going to go, and then once it gets going, you got to let them go so they can actually make you the money, right? So in a trade that I want to talk about, this trade, a CRM, we were trading this today because it was a really hot stock, 269 long, and this is where we went long, and it took off. And the way I was managing this trade is, where were they going and then backing off of before they kept going again? So to the upside, where they were going to the upside, we backed down a little bit and then kept going. Every time we back down, I want to know what that point is. And every time we bounce back up, I move my stop below that. In this case, we went from 269 with a 265 stop. Then it moved up, went all the way to 273, came back down to 271.50 and took off again. So we moved the stop just underneath 271.50. And then it bounced and then took off again to 275. And in this situation, what I did was I moved the stop to 273.50 just because we had already hesitated a few times before we actually made it to 275. So in my head, I'm thinking, you know what? If they can come back in here again one more time, then odds are the selling that was there is going to be enough to end this trend. So let's just walk away from it, right? And that's what we did. And since we've gotten out, the stock has done absolutely nothing. So the call there was we put the stop in the right place. Now, that was one trade that was this morning. And another trade I actually have on this right now is Airbnb. We are short just below 157, and we're trying to trail this down. Now, this is trading almost $3.50 in the money. How do we trail this? Well, the last point where we really try to get up and couldn't is around 155. So you know what? My stop is there. In this case, because the trade's already going, I'm trying to lock in as much as possible while giving a chance for it to actually keep on going. So in this case, I will give up $1.25 or so, but the opportunity I'm going to gain is, look at that, we have potential to go down all the way to 150. So we're going to give it the chance to. We're just going to give up $1.25 in the event that it comes back.
So understand what the situation is overall, understand how the stock is actually trading when it comes to those key levels before you draw that line in the sand, as we say. And we have to understand exactly where those key levels are. So very important. Lots of great stuff there on proper stop placement, guys. Here is Valeria.
Hey guys, thank you for this useful information. Dear viewers, please subscribe to this channel to see more great videos.